Most people think economic crises happen suddenly. One day the market is hitting new highs. Retirement accounts look strong. Headlines feel optimistic. Then something breaks. A bank collapses. A currency plunges. Stocks fall 30% in weeks, and everyone asks the same question. How did this happen so fast? But according to Dalio, it never happens fast. It builds quietly for years. Dalio, the founder of Bridgewater Associates and one of the most respected macro investors in the world, has spent decades studying how economies rise, peak, and eventually decline. He doesn't look at markets week to week. He studies centuries of history, empires reserve, currencies, debt booms, currency devaluations, civil conflict, external conflict, and he found that the pattern repeats with almost mechanical precision. The dangerous part is not the crash itself. The dangerous part is the late stage of the long-term debt cycle, when the system looks stable on the surface, but is structurally fragile underneath. To understand his warning for 2026, you first have to understand the cycle. In the short term, economies move in small waves. Businesses expand, consumers borrow, central banks adjust interest rates. Recessions happen every 5 to 10 years. These are normal cycles. They reset excess and allow growth to continue. But underneath these short cycles is a much bigger one, a long-term debt cycle that lasts 50 to 75 years. It begins when debt levels are low and growth is strong. Over decades, governments, corporations, and households borrow more and more because borrowing creates growth. When you borrow, you can spend more than you earn. That spending becomes someone else's income. Asset prices rise. Confidence builds. Eventually, debt grows faster than income. At first, it doesn't feel dangerous. Interest rates are manageable. Central banks can cut rates when the economy slows. They can print money to stimulate activity. Each downturn gets fixed with more liquidity. Each crisis gets solved with more debt, until rates hit zero, until balance sheets explode, until printing money no longer creates real growth, but instead fuels inflation and asset bubbles. This is where Dalio believes we are now. After the 2008 financial crisis, central banks around the world, led by the Federal Reserve, slashed interest rates to near zero and printed trillions of dollars. It worked in the short term. Markets recovered. The economy stabilized. But the solution required more debt than the problem. Then came 2020, even more money printing, even more fiscal stimulus. Government debt surged to levels not seen since World War II. Corporate debt climbed. Household debt expanded again. For years, low interest rates made this sustainable. But when inflation surged, central banks were forced to raise rates aggressively. And that's when the pressure began. In a late-stage debt cycle, raising rates becomes dangerous because the entire system is dependent on cheap money. Governments struggle to service their debt. Corporations face refinancing risk. Asset prices, which were built on low discount rates, begin to wobble. Dalio often explains that when debt is too high, policymakers have only four options. They can cut spending, they can raise taxes, they can restructure or default on debt, or they can print money and devalue the currency. Historically, when debt reaches extreme levels, countries choose a mix of these. But the most politically acceptable option is usually currency devaluation. It's less visible. It spreads the pain through inflation rather than explicit default. This is why the late stage is so dangerous for savers. If you hold cash, purchasing power erodes. If you hold bonds, rising inflation can destroy real returns. If you hold stocks at historically high valuations, volatility increases as liquidity tightens. But the long-term debt cycle is only part of Dalio's warning. He also studies internal conflict and external conflict. Internally, wealth gaps widen during late-stage cycles. Asset owners benefit from money printing. Wage earners struggle with rising living costs. Political polarization increases. Trust in institutions declines. Elections become more divisive. Policy becomes less predictable. Externally, rising powers challenge established ones. Trade wars escalate. Sanctions increase. Capital flows become strategic weapons. Supply chains fragment. Dalio has compared the current environment to past periods when dominant powers began losing relative strength while emerging powers gained influence. He doesn't predict exact outcomes. He studies probabilities. When you combine extreme debt, internal political tension, and shifting global power, the system becomes more fragile. Now here's the critical part. Late-stage debt cycles don't mean collapse tomorrow. They mean volatility increases, policy becomes reactive instead of proactive, markets move more violently, confidence becomes the key variable. In highly indebted systems, confidence is everything. As long as investors believe governments can manage debt, yields stay controlled, currencies remain stable, but if confidence cracks, capital moves quickly. Dalio has warned about what he calls capital wars, not military wars necessarily, but wars fought through money, sanctions that freeze foreign reserves, restrictions on cross-border investment, currency manipulation, strategic tariffs, export controls. When countries realize that financial systems can be weaponized, they begin reducing dependence. They diversify reserves. They explore alternative payment systems. They seek bilateral trade agreements outside traditional frameworks. This doesn't mean the global financial system collapses. It means fragmentation increases. For investors, fragmentation means higher risk premiums. It means more unpredictable currency moves. It means geopolitical headlines affecting portfolios in ways they didn't 10 years ago. So what does this mean for 2026? Dalio's framework suggests we are in the tightening phase. After an extraordinary period of monetary expansion, debt is high. Interest rates are higher than they were for most of the past decade. Governments face rising interest expenses. Political polarization remains elevated. Global power competition is intensifying. In past cycles, this stage often led to one of two paths: a deflationary bust where asset prices fall sharply and debt gets restructured, or an inflationary resolution where currencies are gradually devalued to reduce the real burden of debt. Sometimes both, sequentially. Markets may experience sharp corrections followed by aggressive policy responses. Central banks may be forced to choose between controlling inflation and stabilizing financial systems. If you understand the cycle, you don't panic at volatility. You expect it. You design your portfolio for it. You reduce reliance on a single outcome. Dalio himself often holds a balanced approach: equities for growth, bonds for deflation protection, gold and other hard assets for currency risk, geographic diversification to reduce single country exposure. The question for 2026 is not whether there will be volatility, it's whether investors will adapt. Because the final phase of the debt cycle is not defined by one crash, it's defined by a gradual shift in how money behaves: higher structural inflation, more active fiscal policy, strategic capital controls, currency competition, increased regulation, more frequent market swings. If you prepare mentally and financially, this environment creates opportunity. If you assume the past decade will repeat exactly, it creates shock. Ray Dalio's warning is not dramatic for attention. It's rooted in pattern recognition. Study history long enough and you see the rhythm. Debt builds, confidence peaks, policy stretches, tensions rise, adjustment comes. The only uncertainty is the path. Will policymakers engineer a soft deleveraging? Will inflation run hotter to erode debt? Will financial repression quietly reduce real returns on savings? Or will a sharper correction force rapid restructuring? We don't know. But we do know the ingredients are present, and in late-stage cycles, preparation is not pessimism, it's discipline. Because when the system transitions, it rewards those who understood the structure long before the headlines did. The next few years may not look like the last 15. Liquidity may not feel as abundant. Volatility may not fade as quickly. Political decisions may matter more than earnings reports. If Dalio's framework is correct, we are not at the beginning of a new easy money boom. We are navigating the complex endgame of a multi-decade debt expansion. And history shows that the endgame is where wealth is either protected or permanently impaired. The choice is not about predicting the exact crash date. The choice is whether you acknowledge the cycle or ignore it. Because cycles don't stop repeating just because we prefer comfort. They repeat because human behavior repeats. And that is the real warning for 2026. And this is where investors get trapped. Most investors are conditioned by the last 15 years. Buy the dip. Expect central bank rescue. Assume liquidity will always return quickly. But late-stage cycles are different because policymakers have less room to maneuver. When inflation is elevated, printing money carries consequences. When debt is high, fiscal stimulus increases long-term risk. Dalio emphasizes diversification across asset classes and geographies, not extreme bets, not panic, but strategic balance, assets that perform differently in inflation versus deflation. Exposure to multiple currencies, real assets alongside financial assets. He often says the biggest mistake investors make is believing that what worked in the recent past will continue indefinitely. History says otherwise. In the 1930s, the United States devalued the dollar against gold. In the 1970s, inflation eroded purchasing power dramatically. In multiple emerging markets, debt crises wiped out savings through currency collapses. These were not random events, they were late-stage debt outcomes. The purpose of studying cycles is not to predict exact dates. It's to recognize structural conditions. Right now, global debt relative to income is near historic highs. Interest expenses are rising. Demographics in many developed countries are slowing growth. Productivity gains must accelerate to offset debt burdens, and geopolitical alignment is shifting. None of this guarantees catastrophe, but it increases the range of possible outcomes. And that's the key. In early-stage cycles, outcomes cluster tightly around steady growth. In late-stage cycles, outcomes spread wider. Higher highs, lower lows, faster policy shifts. For content creators like Dalio, the goal is not fear, it's preparation.